All right, guys, in this week's Week Ahead video, we'll cover the trading week running from Monday the 12th to Friday the 16th of October 2021. Now, our main focus will turn to the Kiwi dollar, where we do see some potential for medium-term upside opportunities developing after this week's RBNZ. Now, at the October meeting this past week, the RBNZ delivered on a 25 basis point rate hike, which was largely expected and already priced by the market. But the Kiwi dollar didn't really respond favorably to the hike. Now, since a 25 basis point hike was already fully expected as well as priced in, and since the bar for a hawkish surprise from the bank was quite high going into the meeting, and the fact that the RBNZ didn't really provide any material changes in their statement, the buy-the-rumour-sell-the-fact downside reaction in the Kiwi dollar wasn't really all that surprising in this past week. But, the most important part or takeaway from that RBNZ statement was their comments that the current COVID-19 related restrictions have not materially changed the medium-term outlook for inflation and employment since the August statement. So, despite seeing inflation above 4% in the near term, the bank's outlook for both inflation and employment remains unchanged. And that also means that the August rate path also remains intact for now. So recall that at the August meeting, the bank projected a total of 7 hikes between the fourth quarter of this year and the first half of 2023, bringing the OCR to just above 2%. So the fact that the Kiwi dollar pushed lower, but the overall rate path remains unchanged, that opens up some opportunities for long trades in the Kiwi dollar from more attractive levels, especially versus those low yielding currencies like the Japanese yen, as well as the Swiss franc, even the US dollar. Now, remember that with the cash rate now sitting at 50 basis points or 0.5%, the Kiwi has the highest interest rate among the major central currencies. And even if we just get halfway to where the RBNZ projects interest rates to go, it puts the RBNZ just miles ahead of its peers. Now, in the months ahead, as interest rates start to climb higher and higher in line with those projections, that will create, in our opinion, a lot of carry attractiveness for the Kiwi dollar, especially once again versus those low yielding or negative yielding currencies like the Japanese yen, the Swiss franc, as well as the euro. And as long as the virus remains under control in New Zealand, the medium-term bias for the Kiwi dollar, in our opinion, remains firmly intact and tilted to the upside. Now, in terms of a possible week ahead scenario, we do have a very light economic schedule. The only highlights will be US economic data points, and with the Fed at that September meeting already acknowledging a November taper as well as a mid-2022 conclusion, there might not be as much volatility as we would normally expect from those incoming data points. There will, of course, be lots of focus on the incoming US CPI, and that can, of course, create some jitters with all of the concerns right now going on the energy front. But, since economic data isn't really expected to be a huge volatility impact driver this week, the main focus point for us for the week ahead will be on overall risk sentiment, which will be especially important for those very risk-sensitive Kiwi dollar pairs like the Kiwi yen, the Kiwi Swiss franc, as well as the Kiwi versus the US dollar. With the Japanese yen, we already had quite a hit in the last week, the Japanese yen, due to that sharp rise to the upside in US 10-year yields. Remember, we've got a very strong inverse correlation to US 10-year yields as well as the Japanese yen. So a lot of that weakness in the Japanese yen was mainly driven by the move in yields. So with that, upside that we've already seen in things like Kiwi yen, there could be some catch-up potential to the upside for the likes of the Kiwi Swiss franc as well as the Kiwi versus the US dollar. And keep in mind, even though our fundamental outlook for the dollar has shifted to a weak bullish one, potential reflationary headwinds in the next couple of weeks could also pressure the US dollar. And since rate differentials still favor the Kiwi above the dollar, there could be some interesting medium-term opportunities to the upside for that pair as well. The biggest risk, of course, to further downside for these three Kiwi dollar pairs is, of course, any major risk of flows, right? If that comes into play, potentially from further inflationary concerns or potential concerns out of China's slowdown or the real estate sector, with them now being back from holiday, also concerns on the geopolitical side between China and Taiwan, etc. If those types of things escalate, of course, it can create some further downside for the Kiwi dollar. And since these three pairs are still relatively close to recent lows that we've been trading at, any further risk of flows that pushes these pairs lower could, in our opinion, be used as opportunities to scale back into longs from more attractive levels, since the medium-term bias still remains tilted to the upside. Now, given the recent, whipsaw that we've had in risk sentiment, all three pairs offer some solid areas to limit and define risk with to the downside. So if we do, see any major risk of flows flushing the Kiwi dollar pairs lower, we could use some of those key technical levels to the downside, not necessarily to just jump in as the markets retest these levels lower, but potentially looking for some false break opportunities. That would probably be a preferred way of approaching any type of big flushes to the downside in the likes of the Kiwi yen as well as the Kiwi Swiss franc. Now, looking at some potential risk on and risk off triggers that we can use to scale into some potential medium-term buying opportunities for these pairs. The first one would be a de-escalation of the current energy concerns, which reduces those inflationary concerns. From a risk sentiment point of view, that has been a key focus for the markets more recently. If that starts to dissipate, that could translate into some upside for overall risk sentiment, which would be positive for both the Kiwi dollar as well as the Kiwi Swiss franc. The reason why we've actually opted for a downside potential move on the Kiwi yen, if that's the case, is remember that oil prices is currently a double whammy negative for the yen, because rising oil prices is obviously increasing inflation fears, which is pushing US 10-year yields to the upside. And remember, there's a strong inverse correlation between the Japanese yen and US 10-year yields. And apart from that, rising oil prices is also a negative for Japan from a terms of trade point of view. So if we have further energy concerns, if we have further energy concerns playing out, which pushes yields to the upside, that can, of course, see further downside for the Japanese yen. But if we have further de-escalation of those concerns with WTI pushing lower, US yields pushing lower, that is actually expected to be more of a positive for the Japanese yen. So despite it potentially creating an overall risk-on environment, it might actually create a little bit of an upside caveat for the Japanese yen. So that's really a key consideration just to keep in mind on the energy front, at least. And then, of course, the exact opposite when it comes to a risk-off trigger. In terms of China's real estate concerns, obviously we've got Evergrande, we've got Fantasia. All of that is still in the mix. We had the Chinese participants away for the Golden Week holidays. Now with that out of the way, participants coming back into focus, those types of concerns will still be there. If we've got any type of positive developments coming out from that sector, it should be more of a positive from a risk sentiment point of view. Obviously positive for all three pairs. Negative developments, negative for all three pairs. Apart from that, if we have some surprise stimulus announcements coming out from the Chinese Communist Party, as well as the PBOC, that should also lift overall market sentiment, which should be positive for all. And then, from a very big risk-off trigger point of view, we've had a more and more geopolitical escalation between China as well as Taiwan. So definitely focusing on that as well. Obviously, don't hope for anything negative to happen, but if we do have any major military escalations between those two, that's certainly going to be a real risk of environment and a real threat to all three of those currency pairs. So that is what we're looking at in the week ahead from a potential medium-term opportunity point of view. If things just stay stable and overall risk sentiment remains fair, wouldn't have any problem allocating some additional positions to the upside in those three pairs. But again, overall risk sentiment will be very key for those three pairs in the week ahead.